Hi, and welcome to Oil Matters from Argus on the 8th of March. This is the video formerly known as the Russian Crude Shock. We've changed the title to reflect the broad array of factors driving global crude and products markets. Otherwise, hopefully the content will be familiar to our watchers. Crude futures are oscillating between $80 and $85 for ICE Brent, $75 and $80 for NYMEX WTI. We've got support out there from recovery prospects in China's domestic oil demand, its refiner crude appetite, and resultant imports. The country's parliament this weekend cited a rather ambiguous 2023 GDP target of around 5%. Nonetheless, this could potentially generate oil demand growth in China this year of upwards of 800,000 barrels a day after the stagnation seen in 2022. January, February crude imports to China were nearly 1 million barrels per day below late 2022 levels, but imports are expected to rebound, with Beijing highlighting infrastructure spending and renewed real estate funding, which both imply strong diesel demand in particular. Jet kerosene demand too is likely to come back strongly, with January airline passenger kilometers in China doubling from depressed December levels, boosted in part by obviously the Lunar New Year holiday. 1 month into the G7's refined products price cap for Russian exports, and we've seen indications of Russian diesel trading at discounts of $30 to $35 a barrel below ARA material and $15 to $20 per barrel below the $100 price cap. Russian products shut out of Europe by the embargo seem for now to be finding markets in North Africa, the Middle East, and Latin America, but it's still early to evaluate the definitive impact of the product's embargo and price cap, but it's certainly tightening long-haul clean freight availability. And Russia's total products exports in February seem to have fallen by as much as 400,000 barrels a day compared to January. Perceptions of a strengthening broader prompt oil market are further borne out by North Sea Dated's gains versus ICE Brent futures, alongside the flip of futures to renewed backwardation compared to a flirtation with contango that we saw back in January. February data on Russian seaborne crude exports show European purchases remaining at minimal levels, and overall exports were down by around 200,000 barrels a day versus January. Europe's also now seen a halt to the 550,000 barrels a day of crude formerly moving to Poland and Germany via the Druzhba pipeline. So Atlantic Basin crude grades are largely locked within the region to replace eastbound Russian cargoes, with much of the US's 4 million barrels a day of crude exports now bound for Europe. Not surprisingly, US physical flows and the incorporation of WTI into the North Sea Brent basket from mid-year were both hot topics at last week's IE Week gatherings in London. This major change to the global Brent benchmark confirms Midland WTI's coming of age as a truly global crude grade, and it also transforms the US Gulf Coast into arguably the global price-setting venue for crude. So what's to look out for in the next couple of weeks? Next week sees release of IEA and OPEC monthly oil market reports, and together with our own Argus fundamentals, these may elaborate further on China's 2023 oil demand rebound. G7 member governments review the crude and oil products price caps for Russian exports in the second half of March, but the market really expects them to leave the caps pretty much where they are. The US Federal Reserve is likely to adjust interest rates higher again, potentially by as much as 50 basis points on the 22nd of March. So look out for this week's US jobs report and next week's inflation print for clues on that. New York Fed data imply an easing of global supply chain bottlenecks, but inflation is now increasingly due to tight labor markets and rising wage claims. So I suspect there's more policy tightening to come. Thanks for watching this episode of Oil Matters. And don't forget to check out argusmedia.com, Argus Crude, and Argus Asia Pacific products for all the best in pricing, news, and analysis. Bye for now.